Thanks for tuning into Alpha Moguls, a show where we speak to some of the finest investing minds about their portfolio construct in the current landscape. Our guest today is Samir Arora of Helios. He needs no introduction. Samir, great having you on the show.
Thank you very much. Thanks.
Samir, just trying I mean, your outlook is well known. I don't need to reiterate that. Can I start off by asking you, therefore, what is your basic approach to a portfolio construction?
So basically, our approach is that basically there are a lot of stocks in the market, let's say 100, 200, whatever. Our universe is around 400 technically. And broadly, we first want to weed out bad stocks on the basis of 8 factors. And we have realized over time, previously we used to make compromises like saying it's high quality, therefore it can have very high valuation. But over the years, we realized that we will veto on even one of these factors. So if the theme is bad, if the history is bad, if a newer factor, if there's a potential disruption, it is bad. If it has high valuations, it is bad, independent of everything else. If it has if it has bad financials or bad examples that we know of corporate governance, or if it has bad expected results in the next 3, 4, 5 quarters, any of these we will reject. But once in a while, we have accepted, say, what we call a bad theme, saying that, no, this stock doesn't define the theme, or the theme doesn't define the stock. For example, we generally say we don't like commodity companies as a bad theme. Or we say we don't like PSUs as a bad theme. But once in a while, we might take it if that stock is, sort of better than the theme in a very significant way. But broadly, the idea is to first reject. Then from the stocks that cannot be rejected on any of these factors, we look for the positives.
Okay.
And it works so well that one day I will show you the formula. It is really a good formula, easy formula. Reason being that to reject needs a few lines. To say something is good, there is no end. For bad, one line is enough. Doesn't matter what else is there. We don't like the fellow's history. Now, somebody else will say, we like it because it is cheap. Okay, so they will also know he has a bad history or something. There are many examples. Or many people will know that let us say, the valuations are not just high. They are unprecedented, but they'll say it is very good company. These are the places where these trade-offs are made. So initially, everybody tries to make a formula saying, I will give so much weight to this factor, so much weight to the other factor. And we over time realize that so many stocks still do well that there is no need to make that trade-off. But even then, in our 35 stocks, you might say one stock is very expensive and we'll say, okay, doesn't matter. The idea is nothing is 100% black and white. It should be 80, 90% black and white. And 10% is still choices have to be made.
Okay. And within this construct, you managed to find 35 stocks for your portfolio.
No, we are able to find 80 stocks, which we say cannot be rejected on any factor. That means it doesn't have a bad history. It doesn't have a bad theme. That means generally it has a good theme, but we are just saying in a bad way. It doesn't have very high valuations relative to its sector or its own history. We don't know anything bad about them.
Mm-hmm.
But then you look for the good. And I'll give you many examples if you want. So, for example, let us say you are trying to buy a relatively new company, which has gone IPO recently, let's say. And some of them may have private equity history, but some may have, nothing that you know about. Now, we will say that the management is not bad if it looks qualified, if it has some skin in the game, they have grown it to whatever level. But we are not there to say you are a good management. You're not bad because we didn't find anything bad about you. You're just one more guy. But you might have other things which are very good, that maybe the industry is very good, or your financial position is good, or your numbers are good in general. Now, unless you say if the numbers are good, management is good, it's a different angle. We are just keeping them separate. And that's why we've been able to buy stocks like Bajaj Finance. How in 2011 would we say that a relatively new guy, Rajiv Jain, is some big hero that we have discovered? Or even Kotak, when it became a bank, we had 5% of the bank we used to in Alliance. And at that time, Kotak has turned from being a broker to a banker. On what basis are we supposed to say this is a good bank or good management? So we say not bad on management because there's nothing bad, but very good on, let's say, the size or market cap, very cheap, or on the theme that it is a competing with state-owned banks at that time, early on, whatever, and very good other income because they had all the other income in terms of broking, investment banking, but no actual banking business also. So the point is that everything is never good. Some things have to be not bad.
Okay. Just
Also, even an expensive company. Let us say we say some company, consumer staple company, normally has a 30 multiple, let's say. And today it has a 35 multiple. What can you say? It's all in the same range, right? There's no formula that 33 will make it good, but 35. So we will say 35 is not bad. It's sort of, or even a 40. But if it is 60, then you can call it bad and reject it.
sure.
So life is mostly of a few non-bad and rest good. Very rarely is it everything is good.
Get your point. Okay. Or maybe in a really bad cycle. But just a couple of
On a
follow-ups.
bad cycle, nobody has given us money to buy it. Correct. And second thing is at that time, not only it is bad cycle at that time for a reason. So you are also confused and you can't run a fund where you say, I only have examples of how I bought a stock in 2008 September, and the next time I bought it is in 2020 March, because everything was good. Actually, it was not good. Let's say the hotel industry was closed. How will you buy it saying I buy ROE and ROC? So we would say results are not bad considering it is closed, but everything else is good or something like that.
And it served you well, I'm sure, as you said. I remember a conversation that we did when in person and then subsequently in a show, wherein you brought out the statistics of how comfortably using this formula you were able to beat returns backdated to a multiple number of years.
So not backdated, not modeling, actual.
Actual, sorry. Excuse
Difference
me.
between some fellows who come with a model. We have actual 26-year history. Yeah, it's a bit good. It's quite good. You can see all the awards there. Basically, just to tell you the Helios, the long short fund, 17 years history is there. We charge even a performance fee, and we have net a performance fee beaten nearly every long only fund in India after charging a performance fee, and the net is only in the 60s, and these guys are at 100, and they charge mutual fund fee. Nearly everybody, one or two will be better.
Well, very interesting. Okay, let's try and get the. So we know the secret of the success. Just a couple of follow-ups there, Samir. By virtue of this, आपने बोला कि, for example, one of the factors is that if the results could likely be bad in the next 3, 4, 5, 6 quarters.
Then we might say everything else is good, but we don't want to buy 5, 6 quarters ahead of time. Yeah.
Okay, so but which would also mean that cyclicals would largely be eliminated, right? Because at some point of time,
cyclicals we are rejecting because we don't like the theme. Exactly. We say in the theme that mostly we will not buy only because cyclicals need a completely different game. The cyclicals game, independent of these factors, is you have to get the macro global factors right, because the biggest angle in a cyclical 90% of the time is the price of that commodity, rather than it is, demand is there or not, because everything is dominated by the price. And you need to worry about what is happening in US and Japan and Brazil and wherever and Russia these days. It's very common. So we are not rejecting it or results. We mostly reject it on the fact that we consider it a bad theme.
Got it.
But once in a while we have bought it. Because we also want to cover ourselves, because our idea is that we want to be very consistent. So in the 17 years, nearly, I think 14 years, we have been nominated for the best India fund. The idea being, we don't want a strategy, I do only this and I will wait for the whole country or the market to fall along with it, which might happen every 5 years. Therefore, see, in 5 years, I beat the market. I want to broadly be up there every year. So once in a while, we have bought 1 or 2 commodity companies, which total might be 4-5%. But at that time, it might make some sense. Oh, China is closed. This is happening. That is happening. India has put protection. It might work for a year, 2 years. In the end, mostly they have not worked for us, nearly ever. But we needed to go through that phase where we feel that if we just cover this angle, we can concentrate on the balance 95% of the portfolio. But otherwise, every day, Tata Steel is going up. We know it is going up. Why are we not having? Buy 2-3% and move on in life.
Just a very practical approach. Samir, so, but currently, I mean, it will be difficult to even construct a portfolio without taking to or without thinking about what the macro view would be, right?
We are
US,
totally into
Russia,
macro. We are
Ukraine,
totally
etc.
into macro, but we are not into this macro that whose steel company has closed down there.
Sure, sure, sure.
I am not a fund manager who says, "Oh, I only look at stocks, but I don't look at economy and I don't look at market." Because let me tell you, whoever says that either is too lazy or has got wrongly influenced by Warren Buffett and Peter Lynch. So let me say, so uh, Warren Buffett says if you spend something like 5 minutes on economics, you've wasted 5 minutes or something like that. The point is, he owns 100 or so, let us say, unlisted companies. He says that every month he gets a report on those 100 companies. That is the economy. He has all the stocks under him, which are representing the economy. We don't get those things. So we have to talk about economy, but he knows whether consumer is doing well, or road is doing well, or broker is doing well, housing, he is selling carpets, he's even selling houses. So why does he need? He already has it. Now, Peter Lynch used to say, oh, just a time waste. Peter Lynch was working in Fidelity. Fidelity had and has and will have tens and twenties or hundreds of economists and these big pictures. He has them. They have given him something. He may not have read it, but it has registered in him. Because either Fidelity should have nobody. He was the head, he was a CIO.
Sure.
The point is, this is all story. You need a little bit because that is how you put into context a little bit of which sector or which district for the next few years, where is the priority if interest rates are going up. You should know that. I mean, that is part and parcel of even projecting a company's next few years. So it's top down, little bit, and bottom up, but commodity is always too specific and too narrow for us to.
No, so what's the top-down view currently, Samir, with all
So
that's happening?
top-down view is that India is relatively very well placed because there are 3 or 4 pools where equities are invested, which is US, Europe, let's say China, India, and maybe Japan also, who knows. But broadly in this, Europe is doing very badly, and everybody can understand why it is doing badly. China is doing badly, for its own macro reasons, but also micro in the sense that the government through its policies has directly hit many companies which are all listed or were listed, and therefore the investor can feel the pain of that. And US is actually doing well, but the Federal Reserve says it has to slow down because the inflation is part of that doing well. So India is relatively well placed. But to make absolute money, which this year has not been made because this year market is flattish, you need other markets to fall, at least US to stop falling. And I think US, whatever fall it has to go through is mostly now. Either it falls in the balance of the quarter or it doesn't fall. And then we say it's discounted. But because you have 3 rate hikes and more commentary, and then let us say by the second or third rate hike, still the inflation number is not looking, then you don't. But whatever has to happen is more or less now. After 2-3 months, either it would have fallen enough, or it will say, I have discounted it and we have gone through the worst possible hikes, and maybe the commentary then also is a bit less hawkish, and then you can move on. So I would think next year we will make absolute money. This year we are trying to relatively be.
So the relative valuations of India being high currently, and let's say the US, Korea, China, etc., being low, you don't think that reverses?
I don't agree. I don't agree with that, because one reason why India's relative valuation looks high is because China, which is a big part of our emerging market index, has fallen some 30-40%. But they have not fallen 30-40% in a general flow of money going here or there. They have fallen because they have actively changed their policies. So it's like saying if a company in India is caught for, let's say, corporate governance, and after 1 hour or 1 day or 1 month, you say it is very cheap. No, you know why it is cheap. One is a natural this thing that different countries were doing or companies were doing, and then suddenly India became a little bit more expensive. India is not, by the way, India has not become more expensive simply because the market is not up this year. So at a market level, how could it have become much? I mean, maybe a little bit sector wise. It is because Europe is specifically hit with its own problem. So if it has become a little cheaper, who knows? Because maybe their earnings also fallen, so it may not have. And China has done major, not minor, corporate governance country type issues.
That's true.
Corporate governance means where the policy change has directly hit and hurt investors.
Yeah.
So if you come in randomly and change policies which hurt for whatever objective you may have, which might be good as a country or whatever, obviously that can't be considered. But bottom line is we haven't gone up for a year.
That's
So
true.
we could have gone much more expensive unless you say that our earnings have fallen, which haven't. So we haven't. It's okay.
So in such a scenario, what is the current allocation? It would have changed a little bit from the last 12 months out. I mean,
It has changed a bit, quite a bit. So, for
Ah.
example, we have three big picture themes that get left from the theme angle,
Okay.
and they are, in practical terms, financials, consumer, and tech. Actually, it is tech, pharma, specialty chemical, which we put in one group, which is exporter. And then consumer is middle class consumer, we say, and the financials are private financials, although we own State Bank in a big way. So in that, currently, and for the last since January, we were underweight tech. But 1 month or so ago, we made it ZERO. Yeah. Because the idea is that there are so many other things which are doing very well in India. Consumers doing well, financial, we have 100 rupees only. So, and IT might go up, but I think it's unlikely that IT will outperform my other two groups for the next 6-9 months, because it is news coming from the US. There is an engineering of a slowdown there. And when US guys are in under pressure or attack, the companies, they're unlikely to have the same level of growth or business to be given to Indian companies, and particularly Europe, which is at 15-20%. The best report I've read on this is actually today from a broker. I can give the name also. It is CLSA. They are saying they are very bullish, or sort of bullish. And they say that the Indian company said, or some company said, that they still see strong demand up to at least second quarter FY23. The second quarter FY23 is 11 days left. The report says it on their cover page, that these companies said, no problem about visibility. Till second quarter, we have no problem, except that this is September 19th, 20th, whatever. And so 10 days are left, and the second quarter is over. Anyway, so our point is, it might still do well or not do well. But if for 9-12 months or 6-9 months, or it falls a lot. And in the last few weeks, many sell-side guys have also put after we have, so like Goldman has done, and I think one more has done. So we are okay in that for the moment, that no IT.
What about the other exporters in that exporters bucket?
No, we have specialty chemicals. We have one, and we have the pharma, although they are not. I mean, special chemicals, SRF has done okay this year. Otherwise, that stock we made 4-5 times. But we have held it from 18, I think. And the pharma is not much, but we have, yeah.
So
it's not so much a pharma, it's an issue of IT, because it's mostly US listed companies, and those listed companies are under attack. And plus, maybe a lot of it may have come from the private equity or VC funded companies which spend on IT as they start their lives. That also, big picture would have slowed down. And also I saw in 2000 that the companies don't know anything about their 6 month later business. They can only see, like these fellows are saying, second quarter, which is like over. And the report is from today, not yesterday. So it's not an old report I'm putting.
Sure.
So the point is, broadly, nobody knows. Even that fellow who's giving the business does not exactly know what all he can cut if you put him under pressure. But he can delay. And therefore, it's not fun, because these valuations are still higher than what they were pre-COVID.
Got it. Samir, just on spec chem, great uptick, a bit of a lull. Suddenly people are talking about not just China +1, but Europe +1 as well for spec chem.
Not pet chem, specialty chemical.
Yeah, specialty chemical, yeah. That's what I'm asking. Yeah, so what's your thought?
So that, these things don't happen so fast, but big picture, it could happen, because the first actually was from Europe, because it was that India can You can not dump is the wrong word, but you can make them in India because India at that time was maybe less environmentally sensitive and all that. So that could be one reason. Second is now everything, but these things, how can they transition while in the middle of this? Even that company there, in 1 minute, what do they do? But broadly, everything needs a critical mass. So now the critical mass might be there in terms of some company from there coming and finding 8 companies, so they know that this is an India-wide advantage. We want an India-wide advantage. Then it is clear that it can sustain. A company-wide advantage is more confusing.
Sure.
So IT is very good, and that way pharma is also good. You can see tens of companies. How can they all succeed?
That's true.
India did not have an advantage. So specialty chemical could be getting there. It's just that we are not used to the multiples of valuation that they had. Like IT, I mean, like more than IT, more like consumer companies.
Yeah.
That we don't like.
Got it. You did mention consumption, though, mid-cap consumption, if I'm not wrong.
Mid-cap, I'm saying middle class.
Middle class consumption. Sorry, that's what I meant. Yeah.
But which is actually, you're right. It becomes mid-cap because the consumer staple guys who are selling to 1 billion consumers are large caps or extreme large cap. And this, what we call low ticket consumer. That means you're going out to eat, or you're buying some shoes, or you are seeing a movie, or you are getting that ethnic wear. All these are not for the 70 crore, and maybe not for the first 50 lakh guys also who want to go abroad and or hotels. So yeah, all those we consider low ticket Indian consumer middle class. Leave out the one end and 70% of the other end.
But that's structural in nature, you reckon?
That is structural because big picture, the middle class itself, if it looks underpenetrated within that, means that you are not seeing underpenetrated in 1.4 billion people, but underpenetrated in say 300-400 million people. So one is simpler to understand that. And second is that, okay, over time, big picture, these guys the pool will grow. Plus, mostly for some of these is that they are here and they still have to open more outlets, or somebody like campus we own has to go to south. Most of their, so within India they can grow first, and then that India part has to grow.
Sure.
And in the medium term to short term, they should grow not at 10-15%. Then we don't like. They should go at least 25%, because what is the use of this under penetration if you're growing at India's GDP rate? India's GDP is growing at 10-12% in rupees. But these large guys, if you see, they grow at 10-12.
Yeah, that's right.
That's no fun. That is like you're buying India. You should buy under penetration in India to grow at least 50-70% more, which is not a lot, by the way, for the size of these fellows.
Sure.
And they can grow at 25, let's say, for 3-4 years. Then who knows? We'll see how it goes.
But hotels are saying that. I mean, hotel companies are coming out and saying that 5 saal that 30, 40, 50%.
So we got both of them.
And
proper time, Lemon Tree and Indian Hotel. So usme kya hai ki their logic is that it is driven by supply. It is not so much, of course, initially they get Arpu and all, and maybe foreigners will come back one day soon, and they are already there. But let me tell you, I go every weekend in Delhi when I'm there to Uber for breakfast. Okay, because you can eat a lot and you can meet everybody. And now last 2 days I've had to show them how many followers I have, because they say not available to outsider, because it's available only for the guests. Because that means they're so full of guests. Otherwise, all my life I've gone. And I've not been a guest. I stay anyway in Delhi, but I just go near my house. So they would never say, now they say, are you a guest? I said, I'm not a guest, but hey, listen, see, don't mess with me kind of thing. And anyway, they let me in. But what I'm saying is that is the extent of practical, just last week's story. So big picture is that they are saying that the cycle will be longer because new hotels have not come online, and the capacity increase of room used to be some 10-12% per annum, and now it is some 2-3-4% per annum. Therefore, this cycle can continue, and for the moment, yes. Whether for that reason or otherwise, next 1 year and all looks good, because your ARPUs are going up, and the number of foreigners, if nothing else, and business travel and conferences, all that has just started. I mean, this is literally, I think these days what conference going on is like the first conference post-COVID in a big way. I mean, I'm talking about the broking conferences.
That's true. Samir, time flies, but I'll take 5 more minutes if you're okay with
Okay,
it.
sure.
Great, thanks. So, one thing about financials, right? You mentioned that almost everybody has a consensus view.
Yeah.
Earnings आएंगे, भाव चलेंगे. I mean, what's your thought there?
No, I
Usually,
agree.
people
Oh,
don't
चलेंगे,
agree.
चल भी रहे हैं. By the
हाँ,
way, you know that people say that how can consensus do well? You tell me, for the last 25 years, was it not convinced this thing, consensus that private banks will take share from state-owned banks? And they did it in front of everybody, and every year we would say the same thing. So some of these things just work. Like everybody broadly agrees that Google is a good company in US, and you see every year it outperforms. It's not that because of that it underperforms, at least its own group. Some of these things are easy. There should not be only that for the sake of. But we also have bought a few smaller banks. Okay, we were one of the early ones to buy IndusInd, and this new round after was beaten up because we thought that it should not have fallen so much. And then we bought one more. Actually, bought two more, but leave the others. Basically, we like financials. We're just going into it because we only have the big ones, the three big ones.
got it. Last two questions. One is on defense. It's always kind of failed to perform or promised a lot and not delivered. Would this time be different?
We have one. So our logic, please remember, is that we buy 35 names. If you buy 10 names, you'll be confused about whether you should have this because you would not get that much conviction. But the whole idea of buying 35 names is that we are buying 10 odd big regular names like HDFC Bank, ICICI Bank, and we are buying 20 of these smaller positions, 2%, 2.5% each, where you are on those 8 factors, it's not negative. And then you're betting on some positives and some hope also. So in that, we have Bharat Electronics, which now because done well this year and others have done as well. It's become maybe 2.8%. And then we add a little bit. If you feel confident, then you are comfortable that it's your own stock. It's already up 20, 30%. You can add. Actually, it's up 50 for us, I think. But when it must have been up 20, 30, we add another 0.5%. So now it's 3 maybe. The point is, 20 stocks allow you to little bit experiment without 100% whether it work, but the odds work because every year some 6-8 of these stocks have to do much better than the market. Rest will plus minus break even with the market, and your job is done. So we have put because it is clear that the intent is there, and the companies that were already there and are getting orders, it looks for the moment natural that it will continue. And there's not threat from private sector in these things because these are all their own guys. And so we overrode the it's a PSU. We don't buy PSUs, but we have 2 PSUs, State Bank and Bharat Electronics.
Interesting. Samir, before we wrap up, one advice, if you will, to people who are looking to construct portfolios on your lines or otherwise, and leave us also with one interesting book that you've read recently.
So interesting book that I have read recently. Okay, forget about my recent. You should say because the new guys should read. So the book they should read is Halo Effect. Will tell you why you should not look at price of a stock to say it is good or not, because the basic logic of that book, which is one of the best books and absolutely easy to read, is that when you say a company is good or bad, basically you're looking at the price. And so there are hundreds of examples and logic that is given, and you'll be convinced that just because a stock has done well for 10 years, therefore it has good management, therefore it has good employees, motivated employees, it meets everything, its cost reduction is good, everything is good just because the stock is doing well. So it says, anyway, read it, it's very, very good. In terms of building a portfolio, we would say one thing, that don't think that you are smarter than the world and saying, I will buy 5 stocks. Particularly if you're working and you're doing this and that, and in the evening you want to read on YouTube which company you should buy and then think that you are convinced. The odds are that some 30% of the companies, 40% will do very well and rest will plus minus. Now look at Prashant Jain. Prashant Jain, who's one of the most successful fund managers. Of course, I was bigger than him in 2003 when I was in Alliance. But he just wrote a letter in which he said that he bought 469 stocks in 19 years. Which means initially, let's say he bought 60 stocks. And then he bought 400 more stocks in 19 years. So he bought more than 20 new stocks a year. And then many of them worked. Rakesh Jhunjhunwala made his money from 10 stocks or big money. But do you think he bought 15 stocks? No, he bought 100 stocks. That's what we also say. We are buying 20 new names every year. Not new names every year. 20 names, of which 5-6 वर्ष तो उनको साइड करके अंदर कर लोगे, ये तो ठीक मिल गए. Okay? वो फिर देखिए how they go on. 13-14 में 5-10 you can say okay चलो 1 more year, 3 more months. 3-4 will disappoint you and you are out of them. You are not going in thinking these are 5 stocks I am convinced about and I am buying 5 stocks. Makes no sense. So be humble and buy little bit more names. You'll also learn more. Otherwise, you're buying 5 stocks every day. You'll overanalyze those companies. We can't be analyzed beyond a point. So that is my advice.
Great. Samir, thank you so much for this. It was lovely and have a great week ahead.
Thank you very much.
Thank you. And viewers, thanks for tuning in. Thanks for tuning in to Alpha Moguls.